leave, right? Thanks for everyone making the trip in this morning, everyone. I will call this month's meeting of the Vermont State Employees Retirement System to order at 9:02 this morning. Again, thank you all for making the trip in. It's really nice to see everyone. First on our agenda this morning is approval of the agenda itself and any announcements.
Move approval, Mr. Chair.
Thank you, Jay. Appreciate it.
I'll second.
Thank you, Betsy. So with the motion and a second, it is on the floor. All those in any discussion on the agenda this morning? Not seeing any. All those in favor of approving the agenda this morning, please signify with an aye.
Aye.
And all those opposed with a nay. Not hearing any. The agenda, the ayes appear to have it. The ayes do have it, and the agenda is approved. Before we move on to the next order of business, any announcements this morning?
Mr. Chair, the only one from staff, I'll just let folks know that we've been invited to testify to the Joint Pension Oversight Committee later today at 3 o'clock. So we'll be doing that and making that presentation, follow up on it at the next meeting.
Excellent. And that, I assume that will be available online too, if anyone's interested in doing it.
Yep.
Great. Excellent. Thank you, Tim. Next on the agenda this morning is approval of the minutes from October 28th, our actuarial valuation meeting. They're in the board packet.
Move to approve as presented the minutes from the October meeting.
Let's take John. Can I take you as a second?
Absolutely.
Thank you, Jay. So the motion is on the floor. Any discussion on the minutes of our last meeting? Not seeing any. All those in favor of approving the minutes from our last meeting, please signify with an aye.
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 And all those opposed with a nay. Hearing none, the ayes appear to have it. The ayes do have it. And the minutes of the actuarial valuation meeting are approved. Next on our agenda this morning is any comments from members of the public.
We have one phone number present in the lobby, if they could identify themselves.
The 516 number. We're just wondering if you're a member of the public who would like to make a public comment. Now is the time of the agenda to do so. While we wait on that, I think that is the only potential true, member of the public. Bill, we don't necessarily need them to identify, right? Because it's a open.
I can just put anonymous.
Yep. No. Just wanted to make sure. So, not hearing that there's appetite for making a comment, I think we can move on to our next agenda item, which will be a presentation from Siegel on the OPEB valuation. Tim, would you like to say anything before Siegel kicks off their presentation?
Sure. Thank you, Mr. Chair. Very happy to have Yuri Rubinson and Matt Strom here from Siegel. Yuri is our lead health actuary and will be presenting the OPEB valuation this year. As with the pension valuations, after we're finished with this, we have a few motions that we'll recommend to the board, consistent with statute, to recommend to the administration and the legislature what the ADEC is this year and a percentage of payroll as well. So we'll present those as we conclude. But for now, Yuri will walk through the presentation. Also, and Yuri, if you can, during your talk, describe what the other materials are. There's the evaluation, and then he provides a few other documents that are not in the presentation, but that are helpful as we review this.
Excellent.
Sir.
Oh, yeah.
Were those included in the board materials? I did not see the Siegel report.
Yes, they're in a folder. So you might not have seen the report itself. You might have seen a folder that I think was labeled OPEB.
Above the, right there, right above that.
Oh.
Because
Got
there
it.
is a
Thank
handful,
you.
so we just wanted to organize them a little bit.
Thank you.
Start.
Sure.
So with that, Yuri.
Thank you, Tim. Good morning. It's a pleasure to present this material to you guys in person. I'm, as Tim said, Yuri Rubinson, the lead health actuary on VSERS, and I'm joined remotely with Nicole Lorenz, the other signing actuary on VSERS, and Ryan Kaus, actuarial analyst and an instrumental member of our team. Our plan is to walk you through today's presentation. However, please feel free to stop us at any time with any questions that you have. I mean, we're here to make sure that you understand what's going on, are comfortable with what it is that we're doing, why we're doing it, any underlying assumptions or ramifications. Like that's why we're here. So moving on. As far as discussion topics, first we're going to talk about the valuation highlights, the assumptions and methods, and then an overview, especially of the things that changed, which in this case are primarily the trend rates, the assumptions about what future healthcare costs will look like. And then we'll delve into the market value of assets, the results from the VAL, and walk through reconciliations of the total OPEB liability and the ADC, the actuarially determined contributions, and the reconciliation of the total OPEB liability and the ADC. Those are in a little bit more detail. Those are two of the attachments, also exhibits that are included in the packet. And then lastly, just an overview of the member demographics, what the population that's covered looks like. Okay. The primary takeaway, or the biggest thing, is the actuarially determined contribution, the ADC. It increased by 12% from 94 million to 105 million. We expected a little more than 4 million. It's due to the annual payroll growth. So what that means is we assumed that the aggregate payroll is going to increase by 3.5% a year. So if the ADC is a level percent of pay, as pay increases 3.5%, the ADC would also increase 3.5%. And then there's also normal plan operations that would also cause it to change, which would be comprised of benefits that are accrued by the state employees working an additional year. They're a year closer to being retired. They have an additional year of service. Also, interest on the aggregate benefit on the liability. And then the normal plan operations are reduced by benefit payments. The subsidies that are made to current retirees.
Yuri, just to tease apart those two components for a minute. So as it stood at the end of last year, we would have expected it to be 98.4. We would have expected it to go up by 4.3 million.
Yes.
And that the other unforeseen increase is 7 million.
Yes.
Okay.
And that 7 million is due to having to update the trend rates to reflect the fact that future healthcare costs, especially for Medicare retirees, is increasing at a faster rate than we had previously assumed.
Thank you.
And as you can see, the ADC as a percent of payroll has increased a little bit over the last couple of years, as shown as ADC as a percent of payroll. And lastly, on this slide, the total OPEB liability, that is the aggregate amount of, it's the present value of future cash flows. It's the liability stream essentially for the next 100 years. That increased by 10%. Moving on. To highlight the assumptions that changed. Every year we look at the per capita claim costs, which is the premiums that are paid to or paid by the non-Medicare retirees, those under 65, and the Medicare retirees, those over 65. That's the cost of providing healthcare coverage to them. And those are annually updated based on the actual calendar year retiree premiums. And the other assumption change was trend rates. Like a big picture macroeconomic view of our expectations for how healthcare costs will increase in the future.
Yuri, do you want to speak to the trend rates a little bit more and sort of how in a typical environment you review them and how they're manifesting here?
Sure. So typically we would expect the state of the world to basically be similar year over year over year. And over the last 2-3 years, there have been a number of like almost macroeconomic shifts in terms of drug coverage, how much more expensive it has been. And normally we would look at our assumptions, specifically healthcare trend, perhaps every other year, in an ideal world, every third year. And our assumptions would sort of bake into that we see trends sort of higher now and they slowly increase to a steady state over time. And that steady state is, as we'll see on the next page, we have it at 4.5%. Which is slightly more than inflation. And the reason for it being slightly higher than inflation is, there's going to be improvements. There's technology improvements in medicine and utilization. People tend over time just to use a little bit more. However, we can't be in a world where healthcare is expected to increase at like 10% every single year, because then the economy would essentially just be healthcare. We don't think that that is a reasonable assumption, even though it's been significantly higher than inflation for like the last, 20 plus years. However, because of the last 2 years, the changes that we've had, one part is like increased utilization, GLP-1s, things like that. We've had to reevaluate our trend rates for the last 2 years and update them with what we're seeing in the world. Okay, so
I think that's helpful. And I'd just point out on the valuation report on page 34, those are the trend rates that Yuri uses. And so it's not like it's just one number that stays static. It shows sort of the expectations of how it starts higher and then steps down to that 4.5 by 2039 and later. So that's kind of the way it manifests.
Okay, so moving on to the next slide. Again, just sort of summarizes what's going on for the per capita claim costs. For looking at it, fortunately, it was a non-story this year. The 2026 renewals were comparable to the 2025, slightly less than we had expected, producing gains for the Medicare retirees as it increased 4% less than we had previously expected, so like 4 to 5%, and the non-Medicare retirees increased comparable to what we had anticipated. And this just provides a little more background on how we develop trend rates. We look for consistency with VSERS, as well as it's another like similar size, similar population, slightly different demographics, but as far as like an overall view, we expect them to be similar. And then moving on to the market value of assets. The assets increased. Here we can see the effect of contributing the ADC. That's the employer contributions. That's the driver why the assets are increasing. Also, investment return over the last few years has exceeded the 7% assumption. However, it's the difference between pay as you go, which would just be making benefit payouts, and contributing the ADC is that ultimately the plan will be 100% funded. And looking at the liability in more detail. Yes.
Can I stop you?
Of course.
For a minute? I'm just trying to, right, as we don't have a lot of control over the healthcare trend rates, unfortunately, but I'm just trying to get a sense of how pre-funding has helped manage the cost overall. And I know that might be hard to tease apart. Maybe we can come back to it. Right, but
it's actually invested in. If we look at the investment income, that 21 million, like the return on assets, that literally is the effect of it. I mean, there's also, you're using a lower discount rate. It produces like a lower liability, and it's, there's advantages from credit perspectives. However, the money that you have in the plan, the assets, that is earning money. And that money that it's earning, if it wasn't pre-funded, would otherwise not be there.
Gotcha.
That's like, if you had to point to one number, it would be the investment income.
Great. Thank you.
So looking at the liability, the valuation results is, in essence, just breaks down the liability, the benefits that are promised or that are going to be paid to the actives versus the retirees. And it compares that with the planned fiduciary net position or assets, which shows the net OPEB liability. And we can see the funding ratio, the planned fiduciary net position as a percentage of total OPEB liability, and that it's been increasing over time because the plan is, funding, it's pre-funding the plan. And the next slide is one of the other exhibits that we included in the report, which is the reconciliation of total OPEB liability. The expected liability, the $1,287,000,000, as mentioned before, that reflects the prior year number plus the benefits that actives earn during the year, plus interest on the prior year's number, plus the benefits less benefit payments. And here we break out the changes due to demographics, the difference between where we expected the population to be and where the population actually was quite small. Per capita claims, the claims experience was slightly better than expected, which also reduced the liability. And then the contribution rates, that reflects the decision made to increase the contribution rates at a certain percent that was slightly higher than the experience would have otherwise justified. In essence, perhaps like smoothing it in over time. So as this was a better year, having it be slightly more so that if there is a worse year, it could be slightly less. But it's a very slight change. And then the biggest change, the 10% increase, is due to updating trend rates. And moving on to the ADC. So here we show the ADC for fiscal year ending 27. The unfunded liability that's amortized over 22 years, with the intent being the plan is fully funded in 2048. And here we show the components of the actuarially determined contribution. In essence, the unfunded liability, the normal cost, the amortization thereof, and the ADC as a percent of payroll. So for instance, for next year, we would expect the ADC as a percent of payroll, assuming all assumptions are met and nothing changes significantly, would also be around 13.5% of payroll. And the ADC would be larger because the payroll is larger. And similar to the total OPEB liability, the reconciliation of the actuarially determined contribution on the next page. It's a similar percentage change where we have the 94.1 million ADC from last year where we expected it to be this year. And then changes due to the demographic experience, which essentially was a wash. The reductions due to good experience on the renewals, on contribution rates, and then the effect of updating the trends. And essentially the whole story is the fact that unfortunately the state of the world has changed. Healthcare costs have increased significantly and are expected to remain high and increasing even more so over time, showing the total increase of 7 million or like 12% year over year.
I was just going to confirm that was the total story, because that's what it seems like to me that there's two elements that were updated here: the experience of the plan, the actual healthcare costs, and then the trend rates.
Yes.
We have pre-funding providing investment income. But so the liabilities, the change in liabilities is that increase in trend rates over time, right? I mean,
Yes.
that's the entire drive.
Yes, that is essentially all, that is the fact, that is the one thing between last year and this year. Were it not for that, it would be, there'd be nothing. It basically looked like exactly what we had expected it to be, even a little lower.
Thank you. That's what I was trying to tease apart.
I was just like as far as the things that are under your control, they're all essentially going fine. It's, future healthcare costs
Yeah,
that aren't.
as I've been discussing this with Yuri and thinking about it myself, I see, substantial changes in the ADEC and get worried, like, is this thing not working? Is there something, is there a glitch in the system? But it's, in talking about it, it's working exactly as one would expect in sort of a runaway health cost environment, right? Where health costs are just going up nationally. We would have to reflect that, because if we don't, then we're not really pre-funding. It would be the same to me as using an overly rosy investment return assumption when markets, capital market assumptions weren't supporting that,
Could I ask,
Of course.
what assumption are you making in healthcare cost inflation next year? You may have mentioned that. I'm just curious at
We are
what you're assuming.
assuming, and this is on page 34 of our valuation.
Yeah.
Just to point where it is. I'll also tell you what it is. So on those under 65, we assume it's going to increase by 9%. And we assume that for Medicare, for those over 65, it's going to increase by 9.5%.
Could you tease that out, how you explained it between the two components?
So for those under 65, medical costs are about 3 to 4 times as much as drug costs. And we assume medical costs will increase by 7 to 8% each year, which is a little higher than it's been in years past. But we assume drug costs will increase, anywhere from like 11% to 15%, depending on whether GLP-1s are covered and to the extent that they're covered, as well as other issues. So we break it into 2 separate components. Now, for Medicare, because, the government is involved and they pay a lot more on the medical side than on the drug side, it's closer to like a 50-50 split. So half of the expense is for medical benefits and half is for drug. And so it's a similar trend rates for those as well, as far as, 7-8% on the medical side and anywhere from like 11 to as high as 15% on the drug side. And we use those numbers and those ratios to come up with the starting healthcare claim costs that you see. Yes.
These healthcare costs, that when you make your assumptions, are you looking at a nationwide average, or is there any regionalization of knowing that our members are more likely to be in New England, Northeast, or Vermont area?
There is very little that's put into the locality of it. I know a couple years ago, we looked specifically at trend rates for Vermont and saw that they were slightly higher than the numbers nationally. That might be something we look into next year, but in general, we don't see as much like regionality as much as a shift. And part of that also will be reflected in the renewals as well, as far as what actually happens year over year. And if the state of the world changes, if all of a sudden there are rate caps that are put in, we would certainly reflect those. If there's other changes that have been made that would cause us to believe that healthcare costs would be lower for this plan than we would see otherwise, those are things we would certainly take into account.
And this may be more for the treasurer's office, but looking at the rate of return, I noticed that it's substantially in excess of what the rate of return was for the pension fund, over 100 basis. I'm just wondering, I know they're managed separately.
They are.
And I think last year was the same story. It may have even been more so. I'm just wondering, how do you account for that? Should we just move all the pension plan to the treasurer's office? Save an awful lot of money.
I think if we were in April of this year, it would be a very different story. It's something that Mike will talk about a lot when the VPIC portfolio is going to be a lot more complex and have more developed in its downside risk mitigation. We were moving towards that and pacing towards that in our investments here. But as one of the things we're actually talking about is to try and move the investments here over to VPIC so that, if the year ended in April, it would have looked much worse because that is much closer to market. We don't have as many liquid assets in that pool of investments. So, I mean, it's, I think, yes, the numbers are what they are, but I think as we're starting to grow this pool of assets, we're looking to get into a more appropriate sort of basket of assets that better matches the long-term liabilities. And so right now we're actually working with VPIC on an asset liability study to try and do that matching.
So you're saying because of your liabilities, you're more leveraged to the market than the VPIC portfolio might be?
I think that's fair to say. We don't have as many liquid assets because we don't have the size and scale to get into those funds, and we don't have the program in place. And so we're looking to, that's sort of the point of our initiative this year, to move the assets to VPIC.
If I could just piggyback off of that. So, as Tim sort of mentioned, the OPEB portfolio's asset allocation targets mirror more or less the VPIC targets, but those asset allocations include a couple different buckets. So there are some mutual funds. There's basically some index funds that are invested in equities and bonds, right? And then, as Tim sort of mentioned, there's that illiquid portion of the portfolio. So there's the private equity and the private credit and the real estate partnerships. So there are these vehicles that are invested in private partnerships that are not marked to market. And so when the dip happened in April, VPIX was not showing that dip as much because those vehicles are not marked to market, right? They kind of stay steady. And so in the OPEB portfolio, even though our target allocation mirrors the VPIC allocation, so our target allocation includes being in those illiquid vehicles, but it takes quite a few years to actually build a position in those vehicles. So we are starting to do that, but we are overweighted versus the VPIC portfolio into those more liquid assets, into the equity and bond mutual funds, which are marked to market every day. And so that is why the portfolio has outperformed, because those assets have actually outperformed the illiquid assets over that period. But the goal is to eventually align the OPEB portfolio with the VPIC portfolio.
I would just note, for the sake of saying it, that the VPIC board or the VPIC investment committee has often pointed precisely to those illiquid assets as their expertise. But yet what I'm hearing is those returns have been inferior to basic market returns. Now, I realize different market cycles, different things happen, but it just seemed odd to me. So take that for what you will.
The returns in the more liquid vehicles have been superior recently. Right. VPIC believes that the risk reward profile of those illiquid assets justifies having them in the portfolio over the long run.
I get it. Just pointing out that so far it seems boring old, bonds and stocks seem to be doing quite well.
That has been the case.
At the same time, it's been a sort of 3-year run of strong general market returns. So
I think that may be somewhat unique to this reporting period too, just because, I mean, the statistics that VPIC points out does reflect a outperformance of the general of the sort of market-based instrument. So I'd have to go back and look at those numbers to really reflect on them. But certainly, maybe in this year, that outperformance didn't manifest, but I thought over the long term, there was fairly significant outperformance of that part. Just
personal comment about that. Looking at my own retirement savings, I'm pretty heavily weighted in equities. Probably more than most people my age. And the market has rewarded that in the very recent past. Makes me smile when I look at my quarterly reports. But at the same time makes me nervous. So just last month, I moved a big chunk, something like it'd be 80 or 90,000 into a bond mutual fund out of equities because I'm worried that this market I think is very volatile, and yes, over the last, however far back you want to look, last couple of years even, it's been making me smile, and I don't think that's sustainable.
Nervous. What crystal ball could have predicted a government shutdown, tariffs, et cetera, and a booming market?
Mm.
Our last page, I don't know, member demographics, just an overview of just the population, slightly more active, the comparable number of people who are covered, the retirees, spouses, and surviving spouses. And essentially, with exactly as we would expect, things look very similar year over year. I don't know if anyone has any other questions, things that we covered, things that they're interested in that we did not cover. We're happy to assist. Walking through some of the other slides that are in the report. We have the reconciliation. The reconciliation of total OPEB liability, which is exactly the same as, page 8 in the presentation. It's the same thing. It just provides a little bit more detail as far as, the differences between expected and actual experience. That's due to the difference between the census that we value, and just kind of shows the components as well.
I think of this as like a cheat sheet. It's just helpful because it has the little one-liner next to, why things are what they are for the liability, and then the same for the ADC.
Yeah, and then similarly for the ADC, it shows the exact same thing, that the differences between expected and actual experience reflects changes due to demographics as well as changes due to assets, and shows the effect of updating the claims, the contributions, the healthcare costs. And then lastly, we have a schedule of the contributions for the next 24 years. Shows a 24-year schedule of what the ADC will look like. And even though as the numbers are increasing, it's staying as a level percent of payroll. So they should be increasing by roughly 3.5% a year, and showing the plan completely, fully funded in 2048. That's what we have.
We both have general questions.
Just that reconciliation of ADEC, that separate file, that really does tease apart those components that I was getting at, puts a number on them. That, our per capita claims was a $4 million benefit to ADEC, contribution rates $2 million benefit to the ADEC, and the trend was a $13 million detriment. So I appreciate that detail on those factors.
Our pleasure.
Going back to Bruce's question about sort of regionalization, knowing that healthcare was a big topic at the legislature last year, and I imagine will be again, if there were changes specific to Vermont, there would be a way to incorporate them into the trend rate future valuations.
Yes, absolutely. That's one thing we are going to work a little closer with Lockton, the vendor, because their assumptions will absolutely reflect what's going on regionally. And those are things that we will want to take into account explicitly in the work that we do as well. I mean, we're looking for consistency, across vendors, across between state employees, state teachers, like those are things that we're looking for to the extent that we can, that it is provided to us.
Any other questions or comments on the OPEB valuation? Seeing none. Thank you, Yuri.
I
Our
think
pleasure.
one thing I'd point out is that I do think as part of, if everything works as we think it might, moving the OPEB assets to VPIC, they'll have a little bit more of a role, obviously, in setting the investment return assumptions and the economic assumptions. They also set the asset smoothing for the pension system. And right now, we don't smooth our assets in the OPEB systems. I think it's because when we started this, the assets were so small that it doesn't make a lot of sense. So this year, we're recognizing the full investment income in setting the ADEC. As these assets get larger, I think it probably does make sense. So I would anticipate over the course of this year having those discussions with VPIC. I've already had some with Eric about the idea, and I think there's value to getting a smoothing mechanism in place now so that when the assets are larger and you get big ups and downs in the market, they're not automatically realized in the first year. So we're going to be doing a little bit more work as part of that transition, and I wouldn't be surprised if we come back to talk about that a little bit more with folks. I think Yuri and I have had a fair amount of discussions on trend assumptions. We're going to be talking more about that. It is optimal not to be moving these around at the pace we're doing. I think the last 3 years we're moving them every year. But if we hadn't, we're just baking in a loss in the future, given what we've seen. So I think the move has been successful and appropriate. I think, going forward, hopefully some of the reform efforts that are, taking hold in Vermont and nationally will start to manifest in the cost data. But we've talked about maybe committing to a schedule of every other year visiting it, but there's risk to that because you could get out of whack if healthcare is rising too much. So
we have something like the Inflation Reduction Act, which all of a sudden causes Medicare costs to increase significantly.
Right. So I think this is going to be, we focused on the funding side in Act 114. I think we're focusing on sort of the, some more nuts and bolts. And I wouldn't be surprised if we come back to you in the middle of the year so that it's not, we can have a conversation where we don't have the valuation in front of us and don't have to act, but can talk a little bit more about it conceptually, what we're seeing and where we want to be.
Thanks again, Yuri.
Our pleasure.
Team.
Thank you.
Appreciate it.
Thank you, guys.
So, Mr. Chair, I have a few motions that I'd recommend to the boards.
Sure.
So the first motion would be to accept the 2025 VSERS GASB 74 OPEB actuarial report as presented by Siegel Consulting.
So moved.
Second.
Any discussion on that motion? Seeing none, all those in favor, please signify with an aye.
Aye.
All those opposed with a nay. Hearing none, the ayes appear to have it, as do have it. The report is accepted.
And if the board would consider a motion to recommend to the governor and general assembly that the fiscal year 27 actually determined employer contribution, or ADEC, to the benefits fund of $105,405,207 be fully funded and appropriated in the next fiscal year in order to achieve and preserve the financial integrity of the fund.
So moved.
Second.
Thank you. Any discussion on this motion? I wanted to give an opportunity for discussion.
I
Can we
support
afford
this.
it?
I would just note that last week or 2 weeks ago, we sent a letter as the treasurer is directed to do by November 1st, asking for $155 million for the pension ADEC. That was 140 plus 15 that we send in extra as a Christmas gift. So you can add 105 to that. That's $260 million. And that's only one of the two pension funds we support. The teachers, I believe, actually is quite a bit more than that. The other thing to keep in mind, the good news, if there is a silver lining, is we allocate this out to departments and agencies, and departments and agencies have different sources of revenue. With VSERS, that's not the case. It's strictly general fund, which is, well, there is some federal funds, but very small. So that's a heavy lift. This one is roughly 40-ish% general fund. So the rest is federal funds or other special funds. So, but nonetheless, I just point out to the board that it's a heavy lift, but we do it because we've committed to. And, you know, I don't think anyone at this table would disagree with that, but it's a heavy lift. So anyway.
Is any component for transportation agency employees coming out of the T fund instead of the general fund?
Yes, it is. They pay their full share from the T fund.
It's a lot of money.
Yeah. You know, the sad part is that, you know, with OPEB anyway, the pool of assets is so small that when you get these knockdown market returns, you know, we get what 21 million, I think was the interest level. If we had a larger pool of assets, it could be even more. So, you know, we're going in the right direction, but, yeah, with anyway, so I've had my say. Let's get it on.
Thank you. And any additional comments? Seeing none, all those in favor, please signify with an aye.
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 All those opposed with a nay. Hearing none, the ayes appear to have it. The ayes do have it. And the ADEC recommendations set.
And I'm going to recommend one more, and this is it's a motion that is, you know, required by law. It still is, I think I've said every year, I'm not sure the use of it, but where the statute requires us to certify the percentage of payroll sufficient to pay the ADEC, and we have a payroll estimate in the actuaries. It's obviously going to be different when we get around to the time. So what our history has been is to certify the projected, based on the projected payroll and the actuarial report. It doesn't commit us to that. Obviously, we're going to utilize the whatever the actual is as we develop with both of your departments over the springtime. But this motion would be to certify that the percentage of payroll of all members sufficient to fund the normal cost and the accrued liability contribution is 13.9% based on the projected payroll shown in the actuarial report. 13.49, isn't that what I said? Or no, sorry, it's 13.49. Just to be clear.
Moved.
There's a motion. Is there a second?
Second.
Thank you, Bruce. The motion's on the floor. Any discussion on the motion? Seeing none, all those in favor of certifying the payroll projection, please signify with an aye.
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 All those opposed with the nay? Seeing none, the ayes appear to have it. The ayes do have it. And the percent of payroll is certified.
Eric, let me just comment.
Sure.
That number, that 13.49% really underlines what the commissioner just said. That's huge. It's
Just for the sake of discussion, Beth and I were just talking about it. For this fiscal year, we use 28.8% for our payroll deduction, which would include for state employees, their pension and their OPEB. That roughly broke down to roughly 9-ish% for OPEB and 19% for pension. We were kind of hoping and praying that we would freeze that percentage of payroll. And we do an awful lot of, well, similar to you guys. I mean, we calculate it on our own, and you know, it's mostly science. There's some art to it. But anyway, we're thinking that I'm kind of speculating here that 28.8% may be a bit low. but we don't know that. Part of the issue is we have vacancies, and that, on the one hand, it's good if you're trying to save general fund money, but it's not good if you're trying to contribute to the pension plan. Because we do it as a percentage of payroll, and if a job is vacant, there's no payroll, so we make no contribution. So part of our percentage of payroll calculation is, how many vacancies, and during COVID, we ran a very high vacancy rate. That's been coming down inexorably. So that may help us freeze that percentage of payroll, but yes, it's pretty onerous. Yeah.
And what's frustrating from my perspective is, I mean, you looked at the pension when we did the actuarial evaluation, the percent of payroll did come down a smidgen. And if you look at the ADEC reconciliation, the experience of the plan and the funding of the plan would have brought that ADEC down if it wasn't for the trend.
Yes, I agree.
I
agree.
Yeah.
Last year, you'll remember we were within, I think, $300,000 of nailing it, which is,
Amazing.
it's kind of, considering there are 26 pay periods and, vacancies and new employees and people who retire. But it was a little bit nerve wracking because, our intention is to hit it. And in many years past, we used to exceed it by a fair amount. But anyway, so we didn't have a lot of fat underneath to lean back on. So we'll have to sharpen our pencils for this year.
We didn't require a mid-year adjustment, though,
That's true.
on the sunny side.
Yeah, that's true.
If I recall, I think the numbers of the OPEB piece is a bit more in the 12 range, isn't it? In the current.
I had a 9 and 19 in my head. I may be wrong.
I had 11 and change at the start of the year. I can't find quickly the mid-year adjustment, but I thought that sent OPEB up a little bit in comparison.
That may have been due to the mid-year correction.
Okay.
Did we change the?
Sorry?
Did we change the amount, or we just
The
changed
amount,
that?
and I think,
Yeah.
but
Which one?
The amount.
it doesn't actually matter.
Yeah, no, it's
Oh,
a lot of money.
It's all going in. Well, my
Yeah.
point is, it's going into the pool, but.
Right.
With that, the next item on our agenda is the open meetings, public records, and ethics training contract review. Justin, I know you're going to take us through this. Tim, do you want to tee it up at all, or?
I think we're trying to do particularly in-person meetings, a brief training. And so Justin's is designed to just kind of give us our markers and raise our antenna where there should be issues. So.
Thank you. Thank you.
Thank you. Yeah, nice to see everyone here. And thank you, Bill. So any of these could take 3 hours on their own in terms of open meeting law, public records, certainly code of ethics, contracts. I think we'd probably get bored with 3 hours of that. But the whole point today is just trying to keep saying my daughter went as a spider girl for Halloween. So a lot of spiders on my mind. So like spider sense is what I'm trying to build in people right now, is just getting to think about this. I know we have a mix of either public employees, state employees here. We have folks who are not, but serve in this capacity. And so I just want to create awareness of these things for folks who may already, be aware, or some who aren't. That's just a good annual reminder. And here, I think the open meeting law certainly treats different boards different ways. And I think here it's important to recognize that all you folks, when you sit in this capacity, regardless of what you do during the rest of your days, are public officials. This is a non-advisory board, so the most stringent set of laws apply in terms of open meeting law. So that's why, for instance, even though we're all here today, the other months when you see just Bill, for instance, in a room, it's because it's the same reason the door is open right now, the same reason that anyone could come into this meeting to attend. Certainly, if people want to talk about something on the agenda, that's why we have the public comment. So in the sense, these are public meetings, all the work product related to them is public. Or public records. It's a question of whether some of that would be exempted. It's why we don't take notes in executive session, for instance, or certain situations where the law recognizes that there won't be full transparency, and that's by design. The other thing just to think about is all records, and I know I could see I can see on Bruce's laptop. I mean, it's probably easier for Bruce when he uses that laptop to remember, but all records created during this board business, regardless of what machine they're on, are public records. So the reason that's important is if a records request came in, that's the first thing you'd probably see me showing up in a Teams call and saying, by the way, where are all your records held? We need text messages, you need Teams chats, the extent that you folks are public officials. So I just want everyone to always think about that, even if there's not a sticker on your device, just thinking about that at a high level. And then the other issue is just the quorum issue. This one, it's a little different because you have a higher quorum number, but like, for instance, municipal retirement board, 3 folks is a quorum. So the idea of if you have 3 people somewhere and all of a sudden a board issue comes up, that's a real no-no. So just thinking about if a quorum of you folks happen to end up at the legislature or something, that you can't just start talking about board business. That's not a warned meeting. The public's not invited. So just always being conscious. I mean, it is helpful to be on a larger board where you don't necessarily have the same issues as a small one, but thinking about that.
That comes into play if you have enough members.
Yeah, so exactly. So
if I just see Bruce.
Nope, that's fine. Although I still would say, I think we don't want to, and it gets into what we call serial communications. It's why we don't take motions or votes by email. We don't settle, you don't go, it's called a hub and a spoke. The Secretary of State's office tells us not to do it. Like, you wouldn't contact everyone and say, big vote coming up. You want to talk about this and get everything teed up, right? Like, I think the idea is we want to really keep board business for boards, because that way the public, getting into it a little bit, agendas, right? We want to, if you read the agenda, not only does it have the physical location, it has a Teams component, but also puts people on notice, puts the public and everyone who's here, representing folks and the general public. It's very clear about time. You see Bill puts things out well in advance of 48 hours. We can't just say retirement issues, for instance. You'll see that we have minutes. We have, in terms of, we've gotten very precise about estimated time that we talk about something. The whole point is that way members of the public, if someone really, hopefully, no one's joined to hear this, but if they wanted to really get off the open meeting law, they could join. We also record this. We have to keep it for a minimum of 30 days now. That's a new open meeting law rule for for advisory boards. Non-advisory decision-making boards. I tell you, the only problem is the language of this, but that it is different for different kinds of boards. So I think those are the sort of high level pieces. The quorum is the one thing for, Bill's always thinking about it. You folks do have a quorum issue where your quorum is different than the number needed for action. So your quorum is 5, but you only need a majority of those present to bind the board. And that is something to think about, especially, if 2 folks had to step out right now, for instance, or something we're always keeping in mind, but something for board members to think about as well is that technically 3 people could bind. If you had 5 at a quorum, 2 stepped out or recused themselves, or even if it was the 3-2 vote, 3 people could actually bind this board. So it's something to think about when you're at just barely quorum someday, something.
Could I prevent that by commenting as I'm leaving? Oh, you're losing the quorum because I'm leaving the room.
If you lost a quorum, it'd be more of a 3-2. You have to preserve a quorum in the sense of if 3 folks go to the restroom right now and we lost a quorum, the board could cease to act at that point, right? Yeah. The quorum is the mechanism by which the board can act. Yeah. So you can still meet, but you just couldn't do anything if you announced,
that my departure creates a loss of a quorum.
Yeah.
That would,
and you wouldn't have to. It's a self-executing in the sense of that's Bill's hawk-like eyes back there are always watching and counting, and the rest of us are trying to have hawk-like eyes in terms of that. And why it's important is just that if for the open meeting law and the Public Records Act, the reason, not only because it's law and because there's a commitment to transparency, it's also that they can result in litigation. Boards, and I've been part of that in prior work, a board's decisions can be attacked for a bunch of different reasons, but one is if quorum is lost potentially, or if there's not a majority supporting it, even if you have a quorum. So I think the idea is the law creates opportunities and requirements for boards to, be transparent, to make sure you have the power to act. They don't want a small minority or even a plurality, but not a quorum, depending on where it is, of folks to bind the board to a decision. So, public comment, you also see that we put it right. Oh, sorry.
Move on to number 4. Here's the final bullet of number 3.
Yes, well, that's
Typo there.
that's I always check. We don't fully know what happened to that, but I appreciate it. What it's supposed to say is it's just raising that alternate members can fully participate, can discuss, can do all those things, but that for quorum purposes, if a elected or appointed person and the alternate is there, you can't both count for quorum purposes. So just want folks to be aware of when, as we think about, and the shuffling of people go to the bathroom or people jump off a call. And that's why I think Bill is always back there, making sure that we're maintaining a quorum, but still, obviously, everyone still has all the rights of participation, things like that.
If that alternate member is serving as a full member in that meeting, they would.
Absolutely. But you just can't double dip in the sense of both folks for quorum purposes.
Yep.
But thank you, Bill. In public comment, you'll see we put it at the beginning. It's what we recommend, for other boards that you're on. I think that's a strong recommendation. Sometimes you see at the end of a 3-hour meeting, and one could argue maybe that's not really facilitating public comment for someone to maybe stay on a meeting for 3 hours to say something. So I think we put it at the beginning. If there was a hot button issue, which certainly you folks could find yourselves in, something to think about is that the law uses reasonable twice in 2 sentences talking about this in terms of there are limits you can put upon public comment, in the sense if you could put limits on the time, things like that. So that way you could still do your meetings, you can put, you still do the business there. And it has to be related to the business of the board in something that's going to be taken up. So if folks felt passionately about a different issue, but the one that wasn't in front of you folks, that's not something that you don't necessarily just have a right to come in and talk about that. That's something where we could say, okay, well, please submit in writing or come back another time if you had a full agenda. So there's certainly public comment. We want public comment, but there are limits that the law allows on it to be put upon it. Then the final 2 pieces on the open meeting law, it's really, as you'll see every month on our website, we have our minutes. The whole point of the minutes just is transparency. We have to have, there's sort of a baseline in the law, but really members and members of the public and folks that are represented by you folks be able to look and see what motions are made, what business was taken up. So really letting, not only do we have the recordings, but like today, it's hard to go through a 3-hour video if you're looking for one thing in particular. So I think the idea is we want to give people, and that's why we have such robust minutes, certainly more than the law requires, but just so folks know. And I know not everyone here has to take it. I always do it. The Secretary of State has a revamped open meeting law guidance that I really suggest. There's been, I think we're 3 sessions in a row that there's been legislative updates to the law, because coming out of COVID, we've been evolving from fully electronic to hybrid. They're also working on sort of municipal issue levels, but the law keeps evolving. It's about I think a 40-minute video. That's all. It's not interactive. It's just recorded. It's right. If you were to Google Secretary of State open meeting law, it's just, I think it's very well done. It's done by their staff and leadership. Highly recommend if you really want to delve into any of these issues further on the open meeting law. Anything before I get to public records? I know it's a lot. I'm sorry. Just trying to at a high level. We could really, there's so many rabbit holes to run down. So that's the sort of meeting side of it. And I always think of it as the other side of the coin is the Public Records Act. So any record that you create as a board member is a public record, which means that, and I put here on slide 6, just to, it's not in quotations because I took out surplusage, but provisions shall be liberally construed and the burden of proof shall be on the public agency to sustain its action. So that means that if someone asks for records related to something that happens in the board or emails or things like that, if something's not going to be provided, we have to have a reason, and the burden of proof is on the state or on the board to sustain that. And so why that's important in that language is because the court looks at that. When the court makes, there's a heavy litigation history on the Public Records Act. And when you read it, the burden is on the state to prove, or the municipality or the government agency or official to sustain that. And so just want folks to think about that. That's written in such a way that the law, the legislature intended, and the courts certainly understand the legislative intent. It's that these records are public. And so just being really thoughtful about, I do say a little flippantly, but not really, when you write emails or, certainly I know a lot of public employees here as well, but for those not, when I write an email, I do think like, what if this was in 7 days? I think because all it takes is a public records request, right? I mean, in the sense of certainly a lot of us probably get them in our day jobs, potentially. I mean, certainly, treasurer's office gets them every day almost. And so I think just the idea of just because you haven't been part of one recently doesn't mean you won't be part of one. And so just always being conscious of that. So yeah, all records you create are public records. The law is very broad about requests to inspect or to make copies. It's sort of some of that copies, language and things are evolving only because gone are the days of ledgers and things like that. So, but certainly there's no cost to inspect, things like that. It's on the agency to handle that, which is why if a records request came in, a lot of it often is we need to get every single record. There's a very short timeline too. It's an initial response is due within 3 days. So I think that's just showing that the law is very serious about this is not a luxurious sort of trip down. Oh yeah, and I'll get to it next week. That's not what the law is, which is why it's so important to just always be thinking about it. It turns into a mad dash of getting everything, finding records, and then figuring out there's something like 250 to 300 eligible redactions under Vermont law. There's a lot of reasons records may not be public, but that still takes time to work through. There's in terms of PHI or PII or confidential personal information, there's a lot of reasons, but it takes time to do the analysis. So I just want people to think about that. If you ever do get a records request related to board work, for instance, that would be something that CCing or forwarding to myself and Tim so we can help folks work through that. In terms of we do live in the Public Records Act response world. I don't know if anyone else does, but certainly have a lot of experience and we'll help folks through that. And yeah, the timing piece is just critically important. So just a couple highlights on 8 is I do want folks to just think about, assume everything is a public record that can be seen. If you're asking for legal advice or something else, but we don't have a deliberative process applicable to this board. There's a municipal deliberative process under C-17 of Section 317 of the law, but that doesn't apply to the state and state boards. So the idea of if you were mulling something or passing drafts back and forth, those are not, unless there was something like in them themselves that was redactable. Just the decision-making process is not. It doesn't have the same privilege for this board. So I just want folks to think about it. Yeah, it's just expansive. I just think that's the important part is the law was written in such a way that the legislature, just like the open meeting law, they expect the records of folks who do public business to be open to the public. And so, I think that is just something to always, nothing to be scared of. It's just something to think about. Just kind of like the sticker on Bruce's computer, I think. It's just something to always be aware. Sorry, Bruce, I keep something to be aware of in the sense of as you create public records, it's what comes with being a public official as you folks are when you sit here. Yes, sir.
What is the retention schedule for general correspondence on VSERS board?
Yeah, it's an interesting question, one that came up yesterday, which is I think, to my knowledge, there is not a records retention policy that has been adopted by a board. And so then it becomes a question of, it's probably, if there's no retention schedule, it's probably all retained. It's all in your email server. And, if you're doing state business, things like that, and there's no destruction time, to my knowledge, at this point, if it's being held, if it's like an electronic record.
So I'm looking at my deleted items in my inbox here, and it have thousands of things in here, but at some point my computer's going to be full.
And the state servers are going to be full.
Right. So maybe it'd be prudent for this board to adopt something with your advice on how to how to do that for those types of general correspondence.
Yeah, no, it's interesting. And I've been thinking about it since it came up yesterday because, the thing is, not only are there limitations to servers and things like that. I mean, if you keep a record, it's obviously always going to be available. But some records, it's what the law calls transitory. Some things, if you send an email to me saying I'm going to be late today for a call or something, once I get that record, it's arguably, once it has done its job of notifying me that Bruce is going to be late, that record is transitory and can be deleted, is in the normal course. But the law treats, the issue is, once you have and it's a good thing, but once you have a records policy, then you just have to make sure you're actually following it is the only issue, I think, in terms of, as VSERS would say, I think it's great to have one. It is just sort of, because you start doing it on the front end of once you get a record, you're creating records and identifying, like, I think this is this type of record, but you can certainly do it even at a lower level, like just adopting a transitory, for instance, of things like scheduling. Like once the scheduling email is done, it no longer serves a purpose. But yeah, I think it's an interesting point. And I think for the state overall, I think it's something that VSERS is very helpful in, and they'll help folks adopt records retention schedules. So on my mind. I think a lot of folks here, maybe not everyone, just for the code of ethics, I want to just quickly get to that, which is, I know a lot of us, I think public servants within, I think the first 90 days now of employment, and then once every 3 years have to do their ethics training. And I think as board, I think Bill keeps track for folks as well and lets people know in maybe December of each year, just of their requirements. So if it's upcoming, that's something you can do through, I believe, the learning management system. I can't remember. They'll flag it for us. Really solid training, and that's an ever evolving piece of the law. And I just put here, especially the links. I believe the gift charts were just updated. But really the spider sense takeaways for these, and I think if you look at link 1, I think it's 10 bullet points. It's really just putting folks on notice of, if you have a conflict, thinking through whether that's a conflict that requires recusal. If it does, that means you're recused from, addressing or dealing with that particular issue. But about just keeping folks above reproach, just thinking through, am I going to benefit in a pecuniary or, fashion? Is someone I'm related to? Is you folks, we deal with a lot of contracts that we're giving you an update to of, oh yeah, it turns out my brother-in-law is actually, the signer of this contract that we're doing, those kind of things, just wanting folks to be aware of potential conflicts. It's a law that applies to everyone in here, just like the open meeting law and the Public Record Act. Even if you aren't thinking about it, it still applies to you. So I think just wanting to create that awareness, the training's wonderful, but even outside the training, I put the link there for the training as well. If folks want a refresher course, I also put the statutes, but I think the quick summary that the Ethics Commission's put out is a really solid document. I think it's 2.5 pages, and something I have bookmarked, just as a quick reference that I encourage folks to always be thinking about. If, especially as a decision-making board, you folks have a lot of issues that come up that you take votes on, and just thinking about that. And often it's about a question of appearance. I think when a conflict comes up, rather than maybe an actual conflict, is at least in my experience. So it's just thinking through those issues and having the tools, and that's certainly something I'm always happy to discuss if helpful.
So we're coming up on the first 3-year anniversary of this new law about the code of ethics. I know I'm probably a month overdue on doing this training, and I probably need to do it again because I did it when it first came out. What is the repercussion if a member doesn't have the training done? Should we not let them sit at a board meeting if they don't have the training done? Like, am I opening a Pandora's